This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. We are about 2 months away from the Planet MicroCap Showcase Vancouver in association with Small Cap Discoveries, happening September 25 and 26, 2024 at the Fairmont Waterfront, Vancouver. And we have announced initial presenting companies, speakers, and sponsors that will be in attendance. We got Paul Andriola, Brent Todd, Jesse Gamble, just to name a few, ready to share their latest insights and what I'd arguably say is one of the best company lineups we've ever put together for our MicroCap Investor Conference. Don't wait. You can register to attend at planetmicrocapshowcase.com. See you in Vancouver. My guest on the show today is Jacob Rowe, founder and CIO of Rogue Funds. We met for the first time at my conference in Las Vegas, and I invited Jacob on the show to share with you all his investing philosophy and strategy. Our focus today is special situations. I like to joke sometimes that most microcap investing theses are likely special situations, where you're making a calculated bet on an upcoming catalyst, for instance. For today's episode, we cover quite a few examples of what makes microcaps and special situations synonymous. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Jacob Rowe. Jacob, thank you for joining me today. How you doing, man?
I'm doing good, man. How you doing?
Oh, just a little summer action. We're recording this Friday, July 19, 2024. It's been a nice week for microcaps. Everyone's like, oh,
Whoa, don't say
yeah, I'm sorry. I feel like I'm gonna
that.
I gotta knock everything, right? Like I don't want to jinx nothing, but no, so we're getting after it. But look, I wanted to invite you on. We met originally at our conference in Vegas. You came for our allocator power hour, so it was really cool to finally to meet you and put a face to the name. And I thought, you know what, let's come on podcast and learn a little bit more about Rogue Funds, your strategy, your background, and showcase that to the our wider investing audience community here. So, Jacob, to start us off, let's start with your background. What inspired you to get into investing? I won't say microcaps in particular, because I know that based on your letters and everything, the special situation, all that kind of stuff. So, investing in general, what led you to this wonderful world, this career of investing?
Yeah, so I started reading about investing. So my parents got me reading when I was little, but then I kind of stopped. And then in high school, I started reading again. And the first investment book I ever picked up was sophomore year of high school, like around that time frame, was You Can Be a Stock Market Genius. Because I'm like, oh, wow, this book sounds like it's going to be super easy. And was not exactly the easiest read of all time for an initial, I know literally nothing about it, but I loved it right off the bat. Probably read it like 2 more times.
Bro,
I
read it for the first time recently, and for me, I was like, whoa, there's
yeah, so that's where I started out
I am
at.
a dingle.
Yeah. So I read so then obviously people suggest Intelligent Investor. By the time I'd already read it, by the time I was getting to Intelligent Investor, I already felt like I was well beyond where Intelligent Investor was teaching you about value investing and those types of things. But value investing stuck really early on. I got super addicted to it for sure. And then come senior year of high school, I was taking online classes and stuff like that. And I was just spending all my online class time just researching companies. That's what I would do for 2 periods out of the day. So 3 hours a day or whatever, 2 hours a day. That's all I would be doing in high school. And then college is when I really started reading into it. And so by the time senior year of high school rolled around, I already knew that this is where I wanted to do. This is what I wanted to do. And so my game plan was I didn't want to go into investment banking. I immediately just like wanted to start a hedge fund. Like that was like the end game for me. Like that was started off
Smart.
the bat. That's what I wanted to do. So I was like, well, I would be flat broke if I started a hedge fund right off the bat. So I quickly put those dots together. And so I was like, I need something to fund that with something else that I love doing. So I ended up getting degrees in mechanical engineering and in economics. So I wasn't going to do an economics initially because I was like, well, I don't really need it, but it ended up being really good. I put it on second semester sophomore year of college, and I hustled through that, and that actually paid for my senior year of college, which gave me like the money I started like for the fund and stuff. And it was 2021 is so I took a break my senior year from investing. I was like, I'm gonna, because I know this is what I want to do. I'm gonna give myself like this one year break. And so I came in, so of course that year was 2020. And 2021 comes in, and I'm starting to like evaluate things, and obviously the tech bubble was there. And so I put a unnecessarily amount of money into Roku puts. Like I put that and then bond puts, and that's what I felt really, they were leaps, and they were fairly far out of the money, and that ended up giving me a huge initial slam. If you ever look at the Roku chart, I think I invested like $380 on like the back half of the fall down, and it went down to like 60.
Nice.
And so that gave me like a huge initial ramp up. And in the meantime, I was running like a personal portfolio of like building a track record of my value investment strategy that's what it was. And it was mainly long only. And then I started the fund in 2023 last year. I initially was going to have 5 investors, ended up with one. They all backed out like really last second. I'd already like, I was like, okay, great, cool. But that one guy stuck with me, and then I was able to have a phenomenal year last year. And that carried me through, and I have quite a few investors now, and a lot more than what I started at. And it's been honestly a blast. I have like a really long runway, and I just love the value investing part of things and really finding my niche within the value investing field and stuff.
I got to give you a lot of credit and some serious kudos, man. Like having gone right from college saying, I know I want to start a hedge fund. I know just going right to that versus
Yeah,
going to work somewhere else, kind of learning the lay of land. Like, no, you know what? Screw it. Like, why wait? Just go.
right.
What
Yeah,
what
because
gave you
I
the
was like, well,
confidence?
I'll build my. Yeah, I was like, I have enough money to where I can give myself this long runway. And of course, when I started the business, I had just met my fiance now, and of course she's in vet school, so it did make things tighter, and that like obviously like made things a little bit tight, but it's been a blast. I love it. I'm super happy that's what I've done, and I'm building the track record because the way I thought about things was I don't think that many people care what my personal portfolio is. It's a lot different when you're managing other people's money and managing large sums of money. And so I was like, I just want to get that experience as fast as I can, and that'll help me build to where I want to go. And that's just kind of how it's worked out. It's worked out really well. Obviously, I had a great year, which helped a lot. And hopefully, I have great future years. But yeah.
Absolutely. All right. So let's dig into your strategy, what your investable universe looks like. Let's now start there. What does your investable universe look like?
Yep. So I kind of we kind of talk like I do look at like special situations. I love inflections and like profitability and things like that. Like that's a huge thing. I obviously everybody loves the compounders, but a lot of the compounders aren't cheap. They're just not near. They're very obvious. Everybody sees them. It's more like, do I want to do 20% a year? Which with my AUM, I felt like I could reach more than that. And that's my goal is to obviously make like more than like that 20% year over year. And so first, I like to look at the crappy companies, right? Like super high debt, like you look at that and you're like, wow, this is there a chance this could go bankrupt? And then I decide, like, is this actually going to go bankrupt? Do they have a good plan in place? Sometimes they're high debt because they're doing some sort of turnaround. Maybe they're like creating a new segment in the business that's like compressing earnings and is making their debt look high, but that's quickly changing. And it's not something you're going to screen for. So like that's a huge universe for me is these really high debt companies that nobody wants to look at because everyone wants a clean balance sheet. And I'm like, that's where I want to go. And usually that downside's already really priced in.
You are the turn in human form, to back to risk on in a sense. I'm just kidding.
Yeah, yeah,
Bad joke.
yeah. And yeah, so I mean, it depends. I'm really picky. I run a concentrated portfolio. You've looked at my letters. It's like, 10 positions usually, maybe 15 at most. I'm not doing a ton of companies, so it allows me to get really picky. And that's only a certain part of my portfolio. For like example, like Consolidated Communications was one of those. There's a lot of downside protection. And I'm no longer invested in Consolidated Communications. That was probably 6 months ago. I sold out of them, but they had a private equity company that had a huge chunk of Searchlight Capital. That's what bailed them out of their debt situation to begin with. And I just saw the downside as there's no way Searchlight's going to let this company fail. I was like, obviously, the risk here is that as soon as they start turning around, Searchlight could take them out. And like maybe I just get a small gain. But I felt like the downside was super limited with them. And what happened was Searchlight ended up taking them out right as they were turning around. So obviously it was an ideal scenario, but I still ended up making a profit. And like that's the kind of like high debt situations I really like. Like Costamare was another one I was looking at. And that was to kind of play like the fact that we have the two biggest canals gone. The order book wasn't huge, and containers hadn't changed at all. So I was immediately like, well, let me go find the crappiest one I can. And they ended up actually being like a really like well-ran company. Usually when I see Greek owners in any sort of shipping company, I am very hesitant, but they actually have like a very friendly like shareholder policy and stuff like that. And then I ended up selling out of it early because I was convinced by somebody else it just wasn't a good game plan. It's one of my mistakes of the last year. And they've gone up like 70% in a few months. But that's the type of like high debt situations I look at. And then I kind of look at like some of these better companies that why are they like hidden? So like for example, like Sezzle, also not invested in Sezzle anymore. Um, Sezzle ended up being like an 8-bagger, I think, for the fund roughly. They were on the Australian exchange. They were buy now, pay later. Obviously, people hear that and they're like, "Oh God, here we go." They were on the Australian exchange. They were not profitable. They finally kind of started turning that around. Insiders owned like 50% of the company, and they were starting to like, well, we have this customer base that's really sticking with us. Let's start like monetizing them. So it was this really like low hanging fruit for them to turn very cash flow positive very easily, and they were super low float. They listed on NASDAQ. When they listed on NASDAQ, I'm telling you, I could get whatever chunks of shares I could because I knew that as soon as they delisted from the ASX, it could cause this huge explosion in the stock price, which is what happened because they were trading at like an ungodly forward free cash flow. And they were growing at, I don't know, like 20% or something, like maybe between 20 and 40%. And it was just this huge situation. They started trading down in like the single digits, and all the company's news were coming out was just super positive. And their float is obviously low because of the huge insider ownership and stuff. And I started buying whatever I could get my hands on, and that like took off. But they were a great company from the standpoint they were just trading really cheap for reasons that were outside of their control. Then they started their buyback program that really helped like push the stock price up and stuff like that. And so those are like the two real situations I look at is like where you have this like really good inflecting company that their profitability is not super obvious at first glance. There's reasons why. So like the low float was like a huge reason there. And then I like those like really high debt companies. And then I'm always looking for some sort of like I'm so picky, there's no reason for me to not have these companies that have a decent catalyst that are also decent compounders as well. And that's like kind of where I just go across the board and stuff like that.
Very cool. Yeah, no, man, I love your approach. I mean, it's, I know you're not specifically a microcap investor, but we were joking before we start pressing record of like, special situations investing. It kind of goes hand in hand with microcap
Right.
investing
Right.
in a lot of ways. So see, I'm just so curious. Like, I mean, I know you mentioned that you read, you can be a stock market genius. It talks about a lot of different ways that are, different than just finding like your classic, value ideas and then just holding them forever. What inspired you to get into these types of ideas or looking for these types of ideas?
So I really liked the idea. Well, one, I knew I wanted to run something concentrated. So that immediately dials me down to where there's not that many special situations that are actually like really like low downside protection, high upside. So I'm always trying to identify my downside, but really if I can find a decent bit of like there's a little bit of downside. So people want like no downside, and that's just not the case. And when you can find these situations where there's huge upside involved, and there might be a little bit more like say like a 35% decline in the stock could be relatively realistic. But if management is competent, which takes some qualitative analysis of like are they do they have their heads up their butt basically and figuring that out and then allowing them to just do what good managements do. I don't know, it just started clicking with me really well. Like that's what I wanted to do because initially like some of my first investments, I've not invested in any of these, was like CVS, like Micron, these like big like things in, like 2019, and Capri Holdings was another one in like 2019 2020. Like none of those I own. And they had good returns. Like I think Micron actually ended up tripling in that like 2019 area, and it was just it kind of felt like I was never sure. I felt like there's a lot more experts staring at these things. CBS ended up doubling, but it took them a while to double. And then they kind of flatlined. And I'm like, if I'm gonna waste my time of these multi-year investments, I want stuff that is going to not just do like 2 or 3 times, which is obviously like a great return. I just want these like bigger compounders that are really going to explode. I love these compounders that just people just overlook for whatever reason. Maybe they don't have a moat. Like maybe they don't have a massive moat. People hate companies with no moats. And there's so many like cheap, well-ran ones that like they can maybe capture some market share. They're not going to be Apple, but I'm not trying to find Apple every time. Like Sezzle. Sezzle does not have a good market share, yet that was a great investment. And so like I don't know, going from that transition to finding like these other companies that were smaller and they didn't have as so like I was investing in GameStop too in 2019, do not own. And that was kind of like my first realization that there's a playground in like these crappy companies. And I was in them at like $3 and I sold at 6, even though I valued them at like 18. Obviously, that was a poor decision. Um, but I don't know, like
I mean,
just
you would have
see.
never known what happened.
No, there's no way. And
Yeah, that's
I
a
want to say like
unicorn.
all of those little things kind of was like I don't want to be invested in these huge companies. I feel I can find them, but I think they're going to take so long. They're going to compress my returns. And then, so I was like, well, let me go look at smaller stuff. And that's all Joel Greenblatt says. If you like read his class and stuff, his class notes, I mean, that's all he talks about is these small cats. And so I was like, well, maybe I'll do that. And I got into like Michael Burry as well. He's more of like that. That's where I kind of got let me invest in these like crappy um, these crappy situations. Let me like look into these. So that's what kind of like where that part of the portfolio came from. And then the small cap, and then what works best in the small cap. And then over time, I started to realize like that inflection in profitability that's hidden that you can't screen for. And I've kind of come up with like screeners that help me narrow it down to like say like 600 stocks. Like, okay, I can go through these and find like 2 or 3. And it's just a lot of reading and you eventually start identifying like, okay, wow, there's actually like a lot of these situations where maybe like, so for example, I am invested in Root. We have an investment in Root. Root's moat is not firmly established, but that doesn't make them a bad investment either. So I kind of like started branching away from like, I need to be in these super moat heavy companies. And like that was like a huge breaking point for me of just finding these really good investments that are well managed, insider ownership or a really good comp plan, downsides relatively protected. Like I don't know it, but they have huge upside. Almost every if you look at every investment that I have, basically all of them have massive upside with a cat. Like if they have some sort of catalyst, they could go up 3, 4, 5 times.
You know what's interesting also about your strategy, and it also kind of I think also points to like where you're at in your career. Like
Mm-hmm.
you're just starting your fund at the same time you're like, how do I differentiate myself? What am I going to be like
Right.
everybody else that, okay, yeah, make 2, 3 times a year, 20% on, annual, that's great, but you're trying to differentiate. You're trying
Right.
to like, there's a lot of Jacobs out there that are running strategies that, are also, looking at small micro cap, maybe even special situations, but, might be playing it a little bit safer now. Then you're like, hey, you know what? I have a long runway. Like, why not go for it? And just at a minimum, I'm doing the work,
Right.
so that, right? Like, cause that seems kind of like where your head's at as well.
Yeah, and clearly like so in 2022, that was kind of like my big track record year that I built off of. I had a good year that year too. And like that just kind of like so the investments I'd made that year, it was only like two investments pulled me to that good record because 2022 was a rough year for most people. Like no, a lot of people didn't have a
Rough.
good year. I
Yeah.
ended up having a decent year, and it was because like Scorpio Tankers was one of those. Like those types of investments, when you have these good managements that are starting to fire on all cylinders, I've noticed the market doesn't necessarily go with the market. I mean, sometimes it does, right? Like if there's a market crash, like you're everything is up shit's creek, but like those investments can still pull through in rougher environments, especially if there's some sort of catalyst there that's external from them. So like that, for example, like the Costa Mare or like my uranium um thesis and stuff. Like sometimes when you have that external stuff with like a well managed company, it can lead to like really good things. And I would say like the uranium investment is the one that I feel most uncomfortable with. And that's because I feel like the downside isn't as protected just because of where I'm invested in uranium. And that is because of where that is, I still feel like it's so priced into badness that there's so much upside there that even with what I would like do like a risk ratio on like something like that, even if I applied like I lose 50% of my money or whatever, it just doesn't make any sense from a value standpoint.
So I now want to go into, I mean, there's so many different types of ideal investments that you look at because you're more special situation. But what's been your favorite? You can name a specific company or not. It's totally up to you. But in your career thus far, what's been one of your favorite special situations that, like, wow, this was real, like, not just that whether it worked out well or not, but it was just really fun and interesting to dig into.
I would definitely say Sezzle, and the reason why is the whole time I'm like, I don't understand. I mean, it's rare. Like, usually I can be like, okay, I get why this is trading so horribly. It makes complete sense. Like, you really do like understand why there's a certain connotation to the stock, and understanding that's really important to understand the downside as well. Um, Sezzle, I could not wrap my head around why it was trading for what it was trading at based off of everything management was saying, executing on what they were saying, and just rapidly converting to a high free cash flow company like yield. And I'm staring at them and I'm like, their revenue is growing based off of like that, like what like I was telling you, like they were like increasing lifetime value of all their customers and stuff. And like that's just like, just the low hanging fruit. And I'm staring at them and that one was fun purely because I knew like usually, I'm like 90% sure, right? Like, and because you have to, that one, I just knew. And so that was kind of fun, just waiting for everybody else to catch on board, I would say. Like, that one was fun for me because of that.
Very cool. What's been one that maybe like caught you completely by surprise, or the thesis maybe didn't work out and ended up being a learning lesson where you're like, all right, that, because I mean, in most of these cases, when you're kind of catalyst investing in a sense as well, is you're
Yeah.
really dependent on management and really what they have to say of like, hey, this can be a big catalyst for us, you know, hint, 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 if we execute, right?
Yes.
You know,
So I would say that I Consolidated Communications, not again, I don't own. That was a learning opportunity for me on really identifying management's incentives. So that was like a huge one. I still made a small return. Um, but that one was just like a huge learning experience for me to be like, okay, yeah, if these PE guys are involved, like it's something I have to pay attention to because management is very. I mean, if you go, they're probably offering, and then I started reading more into after I kind of got screwed by the PE firm. I started looking at other instances of that, and it's very common where you have this really good situation, somebody else has identified it, and they take it private after anything happens, and then they have complete control basically to do that, and or they can leave the company not trading while they discuss the options or whatever. Like it can just completely crash a thesis, either make it way longer than you expected, or just completely ruin it. And so seeing where management was incentivized to ruin that thesis for like public shareholder, that was an eye-opening experience, I would say. And it worked out. I got lucky like in the fact that it worked out the way it worked out. It was something I had identified, like this is a risk. I didn't identify it as big of a risk as what it turned out to be, which is why I made the investment to begin with. And so like that was really eye-opening, and management compensation is something I like super pay attention to now, and who the biggest shareholder. I want to know who the biggest shareholders are usually, and things like that. Maybe not like the back of my hand, but I'll look into them and um stuff like that. Like that was for sure like an eye-opening one. I'm trying to think. I've definitely had like other situations where things haven't worked out, but I try to take a step back, and something I've learned is that some investors are like, yep, I had this situation, so I'm going to learn from this mistake, even though it might not have been a mistake. It could have just been like, that was the risk ratio, right? Like, at the end of the day, I accept on some of my investments, there's more downside than other investments, and there's maybe more upside there, so whatever. And so, say they get hit with the downside, well, now they learn from that, like, I'm never taking that risk again. Um, I have had situations like that where I'm like, well, I read that situation wrong, but that I knew it was there. I knew it was a possibility. I would still make that bet 100 more times, type of thing. You know what I mean?
How do you feel that your thesis may has changed on your willingness to wait longer for either a catalyst to hit or a thesis to play out, as you're evolving and as the fund is continuing to evolve and also grow?
Yeah, it's how management executes. If I think management, maybe I misread management. Like that's a huge thing where I will completely change my mind. And you'll start when the Q2 letter goes out, you'll see that we sold out a Rimini Street, and I talked about it on the blog about why we sold out. I thought based off of what management was saying and their past history that we were going to see more um, what's the word, motivation behind capturing sales and things of that nature. And the more I dug into it, and there's so many like external sources now where you can find information that might not necessarily be like um, straight from the SEC filings and stuff like that, right? And so like you can start like reading like what are their employees saying and things like that. Like you can just read it online. And then I would question. I started like questioning IR, like, hey, what is management doing here? Like, what is happening? Like, what is this being addressed? Things like that, and like I like poke and prod, and then I also like management tells you what they want to do, and then you have to be really knowledgeable. Like, you have to really pay attention if they're actually going to do those things, and if they are not doing the things that they're saying they're going to, I will very quickly shut down a thesis, and that's kind of what happened with Rimini Street. Is I was giving them the time to kind of like turn things around. A lot of the thesis was they got hit by a court case, and that kind of caused like the huge catalyst down. But I knew the downside with Rimini Street was the revenue retention was great. The issues were like pricing power, stuff like that, and so all of those things all those risks came to fruition, and we ended up on the whole position. So and I didn't want it to get out of hand of it continuing to come down if sales started being an issue. The court case went against Rimini Street or whatever, and they're just not selling properly because they haven't adjusted to a post-COVID world. That's not something I want to be a part of, and it's something I'll watch to see if they do start executing, and maybe it just takes them a little bit longer to get their head out there. But it's not something I want to sit around for in the stock when there's other opportunities out there, especially like my size. As there's no reason that I couldn't find another opportunity that was better upside and stuff like that and
Absolutely.
downside.
Absolutely. I wanted to kind of dig into some of the core positions because I really like how you kind of break it down. One is your largest position, Aware. And the thing that stood out to me with regard to the company, not specifically the company itself, but it's actually something that I'm going to be talking about with Maj on a pod at some point. Maj Swaydown from Geo Investing. And that has to do with lumpiness, lumpy revenue businesses and both the opportunity and the downside risk when assessing and how to value and really just just engage with them, right? When you're looking at adding or even considering them for your portfolio. So love to hear your thoughts on, how your comfortableness, I guess I don't know if that's a word, but with lumpier businesses and how that applies, for instance, with your largest core holding, which is Aware.
Right. So I like to normalize most things. And that doesn't mean just like staring at the last 10 years revenue and let's make this a smooth stream. I mean, taking how the company operates and then kind of smoothing that out to how's this going to look, not even necessarily from like a seasonal standpoint. I'm actually doing this with a company I'm investing in right now. I'm not going to go into detail on, but it's like that. It got hit with really bad revenue in Q1. And it's similar to what happened with Ware in Q1 is revenue didn't come out really hot. And management's like, nope, we're probably still going to do double digits. And when they've said that in the past, they still do double digits. And that like lumpiness is not something the market likes at all. And it's very funny because when you look at like managed, like publicly tradable, like management company, like investment management companies, you'll see they all trade usually rough because investing is not a smooth business. And so the investors love those smooth results. And when you're not having it, it really creates opportunity for even from a quarter to quarter basis, which is crazy. Because most investors claim that they look at 6 months to a year, and a lot of them don't. Aware didn't change too much, but on this current one I'm in, they had a bad Q1 because their product worked better than expected, and so I was like, and I was like, oh great, cool, and then it made a complete sense why it did what it did, and management's like, nope, we're still going to keep doing what we've been doing the last 2 years, we're not worried about it. And so when you get like management talk like that, and you've seen how they've executed in the past, I mean, that makes a very exciting that catches my attention, and it's something I like to look at. And normalizing that is super important. Normalizing the revenue stream for like Aware, and a huge thing that I've noticed where I differ from a lot of people is I'll put really rough estimates. I'll do a range for my valuation. I'll have a very large range for my valuation, and so I use the DCF all the time. That used to be like how I kind of would value and like do things like that. That was kind of like my beginner stages, right? And now I just kind of like look at it. And I'm like, that's like not right where I'd want it. And you'll see like when you read like my analysis on the blog and stuff. I mean, that's probably pretty close to how I'm actually valuing these things. And that's how I can go through so many stocks is I'm doing it in my head and I'm coming up with a rough estimation and being like, okay, that's about right. Or no, this doesn't really make much sense. I think it should be something more like here. And I will like dig in further and make sure that like again, management's aligned. Like Bob Eckel is an award-winning biometrics company with he did the same thing before. He's done the CEO has done this exact same thing before, where he took this biometrics company, was award-winning biometrics CEO, and went and sold it for a huge profit. And he's just took over and is basically turning Aware around into the same exact situation. And he's just killing it. They're grading out great on their technology and stuff. And they have like I think they're so this is like the one microcap I have in the portfolio, I believe. We talked about that earlier. And I think they're trading at like 40 million right now, and they have like $28 million in cash. Okay, so my downside is 30%. I'll take that because if management starts executing like I think they can and like they have continued to do over the last 4 years, this upside is way larger than that 30% down. Like that's really my worst case scenario, right? Is that they just because they're free cash flow flat right now for the most part. And it just creates these really good situations that I love to get into and normalize. You would have if they had a bad Q4 too, but honestly, Aware is one of the weird ones where they're having these lumpy revenues and it's not affecting the stock price too much. But people don't like that, and that's why they're kind of converting to that SaaS oriented that ARR model and stuff. And that is exciting, that they're locking in those multi-year contracts, because then they're just putting all their marketing into that lumpy revenue on top of it. And it's kind of almost like the bonus on top of that, like streamlined revenue.
Very, very good. When you're looking at some of the, crappier companies, or I try not to say crappy companies, but maybe, their balance sheet just doesn't look great type
Right,
companies, because everyone has different life cycles, right? They're
right.
different kinds of businesses, where the first glance their balance sheet's always going to look crappy no matter what, right? But when you're looking at some of these situations, what on both sides, what are some catalysts and or upside potential situations that you're like, all right, that I'm locked in. I'm definitely going deeper into looking at this one versus ones where you're like, all right, like I see what they're saying, but I've learned my lesson on a few of these. So, I'd love to hear your thoughts there.
Yeah, so obviously the biggest thing is, why do they have so much debt? So if it's usually, it's either their business is slowly dying and they've tried numerous times to turn it around or do some stupid whatever, and it's just poorly managed, right? So those are almost always red flags. It's been really rare for me to find something where you have this company that's just continuing to add debt and they have no idea where they're going. Like, I've never seen one that's like, oh, yep, we're gonna change our minds and this is gonna work out. So like that's like a really good idea. Is like, does management have like a clear plan in place? Other times you'll get like those high debt situations where you get they are like, well, we're kind of putting a lot of money into this other segment of our business. And those are like really fun ones because it can completely compress earnings and everybody runs away. Debt's high. They just added a ton of debt. Earnings are compressed now. And it creates this like scarier situation for investors. And honestly, that plays a lot to do with a lot of like regular inflection testing. So like Geo Group, I know I'm sure people talk about Geo Group. It's everywhere all the time, but that one, I mean, it's a very similar concept, right? Like their debt's not an issue. They're clearly putting money into their tracking systems and things like that. I'm not invested in Geo Group, and the that like situation where you have the management that's like focusing on that guy, I mean, their prior CEO was fairly good, and that was like a good situation of like, okay, I understand why their debt load's so high. They're obviously like, they're a private prison. Okay, they have a huge real estate portfolio that they're using as collateral, probably, like, and all of that is ties into like, okay, what's the real risk here? And that's like that type of thing where where are they putting the debt? Why are they taking on all this debt? And figuring that out, the why of why is there all this debt? Because if they're just pumping money into this crap product that they have no idea is going to be good and it's a Hail Mary shot, I don't want to be a part of that journey. And maybe it works out sometimes, but I would guess that 99% of the time it doesn't. And that's not the type of journey. I want to see something where like, okay, this business that they're dumping this money into really is promising. And then sometimes there's also like the fun of like, okay, they are putting debt into this, but they could easily get themselves out of it based off of the core business. And like an example of that, a really big example that everybody would know is Facebook. I wasn't invested in Facebook and I'm not invested in Facebook now. But when they started doing the whole metaverse thing, they weren't like obviously piling on debt and stuff, but I think it compressed earnings or whatever, or they wrote stuff off, whatever it was. And Facebook clearly could have easily just turned the switch off and gone right back to being Facebook, and that's what they did. And that was a very like obvious thing looking back on it. Like, okay, obviously they can just turn the switch off. Okay, this is a bad business, and they're not overly investing into it, and kind of take that step back. And then again, it's just those management doesn't know where they're going. They're running in circles, like they're like a chicken with their head cut off. They're just throwing money at the problem. Like those are the red flags, really.
Very cool. Hey, go real quick, going back to Aware, you said something that for me, it seems like it would be a red flag in some respects is, you mentioned that, because the market doesn't love lumpy revenue businesses, now they're focusing on, creating a SaaS product so that there isn't as much lumpiness in the revenue. You know, how much comfort does that give you that they're making some of these decisions based on what the market's telling them when, okay, so it's lumpy. That doesn't mean that normalized revenue year over year isn't going up. So I'm just curious as to your thought process there.
Yeah, no, I don't look at it like that.
Okay.
Yeah, so when they take on the initial contract, before they were just doing what they needed to do. Now they're kind of like, okay, if you want to work with us, we're going to be doing all the maintenance for you for the foreseeable future. And they're kind of just, it's really extra revenue is what they're locking them into, and to creating these long-term partnerships that they're then using to kind of like cascade their revenue up and find new people and things like that. So it's a little different than I think than Bob just turning it around and being like, okay, nope, we just want to please the market. I wasn't getting that. But obviously the market does really like those smooth revenue returns. But when you're looking at like a cyclical company, like a clothing company or something like that, I mean, you have to normalize that. I mean, you're just playing a really dangerous game because that's how you get in on the high. And you're like, okay, yeah, why would they not just keep or at least go with like a lower multiple, like a much lower multiple than what the market's comfortable with? I mean, that can be your safe space too, is for normalizing it or whatever. I mean, that's really all you're doing when you're normalizing it from a risk prevention standpoint, is you're just lowering the multiple significantly.
For sure. Yep.
Yeah.
Sorry, there's one thing that came up. I was like, wait, I
Yeah,
should
you're
have followed up on that earlier, but
Yeah.
but anyways, so one other I guess I'd say, well, it's a core holding and special situation as well that I wanted to ask you about. See, I wanted to go from the highest conviction core to like, maybe 9 or 10 in there. And then and you mentioned it earlier with it, which is uranium, so kind of love to hear your thesis there. I mean, I think it's probably in line with why most people are, looking at a basket of uranium stocks and understand that it's more or less here to stay, but it is. Let's hear your thoughts.
Okay, so I wrote about uranium last year. The uranium price tripled from when I wrote that. I proceeded to not make any money on uranium. The basket, I had a small basket. It was still like a concentrate. It wasn't like I had 20 stocks, right? I wasn't just blindly like throwing them in there. The main issue was the geopolitical risk I had with Niger, specifically Global Atomics. And that's now I got rid of all the other stuff. I just kind of want that exposure to Niger, which obviously sounds crazy. If you really look at the situation,
crazy because there was a coup that just happened in Niger.
Yes, there was a coup
that was
the red flag. Yeah. Yes. So obviously couldn't predicted that one, but Niger's always had coups. So like, to be fair, they've had like 5 coups in like the last 50 years, and that hasn't stopped uranium production. This is the first time where the coup came in and was like, hey, you guys. So uranium, for those of you who don't know, uranium chilled at like $25 a pound for probably a year plus, and they really didn't trade much above $30 a pound. The lowest cost producers in the world produce at like maybe like $18 to $25, and that's Kazakhstan, and then you have China Lake in Canada, which theirs is much higher than that. And then Niger's is $30. So you're really, when it comes to like, by the time everything's said and done, you're not getting a profit at $30. And so what these guys were doing, especially Orano, that's the French company that kind of like goes in, and they've owned mining shares there for a long time. And they give them the mining permits, and then the companies go in there and they start the process, and they're like, wow, this is going to be more expensive than they expected after feasibility studies, whatever it is. And so they just sit on these mining permits, and the government's like, we don't care if you lose money. We want you producing, because Niger gets a 20%, whatever. So their issue is like, we don't really care if you're producing. You're taking too long to give us money, and we gave you this mining permit. This is our land. You need to get a move on. And Orano is kind of just like sitting on it. They didn't want to lose it, but they knew that they were nowhere. Theirs isn't even $30. Theirs is much higher than $30 a pound. The one that they just lost. Anyways, well, when the government stuff comes in and starts taking away mining permits, that caused a huge market scare. Well, Global Atomics really lucky. Their timing was really good with when uranium decided to explode upwards, and they are well within that. What's uranium at, like $85 a pound right now or something like that. They're well within that limit, and so they're going to start producing as fast as they can. And Niger sees them building that mine as fast as they can, and they have come out. It's the only public company that they've come out, or the only uranium mining company where the government's come out and said, no, we support them. We want them like doing what they're doing. And lucky for them, obviously this is like pure dumb luck that because if Global Atomics had started their mining permit 5 years earlier, they wouldn't have mined either. They would have been like, well, I'm not going to just blow money here. And the CEO owns a huge chunk of the company, and based off of current uranium prices and where the uranium market is heading, which is just, I don't see uranium going much lower. It is, and everyone in the industry is panicking. The utility companies aren't yet, especially with natural gas being what it is right now and stuff. There's really no catalyst for the or for the utility companies to be panicking, but there's really the supply side is such a major issue right now because it was so cheap for so long below that production. And then Kazakhstan is now, their production costs are raising. So you're having this like dynamic where the supply side is no longer producing nearly as cheap as what it was. And the pounds are just going away. And so as that spot market gets tighter and tighter, even at the current $85 a pound, you're going to continue to have those issues. But even at $85 a pound, if Global Atomics comes out and assuming uranium price doesn't move, I mean, they're a 2 to 3 bagger based off of their current price, just based off of the pounds they found and how quickly they're going to start getting to that. So the issues now are like funding it and getting into that. So the US has like a development bank for those tiny miners and stuff. And so they've had issues. The US is a little, banks are hesitant. Western banks specifically with Niger, because Niger was like, well, there's also like a bunch of fear that Russia is going to come in and start taking all these mines, which hasn't happened. And Niger's kind of just what they've done is they've gone full protectionism. They're just sick of other people. This coup, this new government is just sick of other big governments being there. I mean, understandable, but the US's reaction was like, oh, if they're kicking us out, they clearly want Russia or China there. And that's not really what we've seen since those initial fears have happened. So it's something I'm paying attention to. And there's a lot of risk there. I am very aware. But I don't think there's risk of losing the mine, purely on the dumb luck fact that, one, I don't think there's any world where uranium goes back down to $30. And Global Atomics is well ahead of the mining schedule of those other two, like way ahead of those other two companies. And so that's me kind of like just breaking down like the risk reward for myself is like, okay, well, if uranium actually goes up to say back over $100, I mean, this thing is now 5, 6, 7, 8, 9, 10, depending on where it goes. And that's just, and my downside, I think, is well priced in. Everybody is aware that they're going to probably get bad financing. What if they get good financing? Now I have this huge upside there. Like, so there is downside. The biggest downside risk from here is they actually come and take the mine, which would be really weird based off the government being like, we're not planning on doing that, basically. We fully support this mine. For some reason, they're only thinking about this mine. It'd be weird if they went back on that. And so, like, that's the biggest risk I have there, and the rest of the upside is there. And it's the smallest part of my portfolio. So it's not like I went in as hard as I could. I'm not really adding to it. I'm just kind of watching it, seeing how things play out, getting more comfortable with the government. Because obviously, I'm not super comfortable with the situation, but this is what I started with, and I still see a lot of upside there, and I don't see the downside that the other companies were experiencing.
See, this is a perfect example of like your highest conviction versus, your more of the lowest conviction. The highest conviction, yeah, you've probably done equal amount of work, like as hard as possible, but the highest conviction description of why it was interesting, it's like, this is why it's highest conviction. You just simply said in like a few sentences, like, and then the lowest conviction, still interesting. You're in it, want to see how it plays out, but then it requires so much more. Like, all right, but here, hold on, let me explain all of what's going on there. So it's always funny to see that the difference, right?
It's for sure, because I mean, there's way more risks there, so that's why it's
way more.
But I like it as like a market neutral play. I think uranium is going to keep going up no matter what everything else does. It's a very illiquid market. They're in like the low buying point of the year and stuff. So I'm not shocked that uranium's ticked down. It's kind of how it goes. And it hasn't ticked down much. I think like 20% from just the huge climb that it had. So I mean, in the scheme of things, it's barely ticked down, and I'm not losing any sleep on the position though.
For sure. Well, look, dude, we're coming up about on the hour here. So, look, you're definitely going to be coming back on to talk on, I'm sure on more special situations, weird stuff as it comes up, stuff that's interesting for sure. So, I mean, to close this out here, I'd love to get your advice that you want to give to new investors that, aside from just picking up, you could be a stock market genius and definitely reading that. But let's say some folks that are like, I'm now kind of going down the rabbit hole of investing just in general. I have my kind of buy and hold portfolio, but I want to start looking at some of the more weirder, interesting, different situations out there. Where should they, after they've kind of done the reading, like what would you recommend that they do?
Yeah, so obviously the reading is the most important. At least getting like a base, understanding accounting, all those huge things. It's just a base. You don't even need to. I mean, at this point, I have a very well understanding of accounting, but you don't need that to start. It's just practicing like the reading of the accounting statements, and then just like practicing like building the story of like the company. I would say is like the biggest thing, right? Like why are they where they're at? Why I don't necessarily I hate when I get a lot of allocators that ask me this. They're like, well, why did you see this and no one else is seeing this? Frankly, I don't care like why other people like I mean sometimes you'll know and sometimes you don't. Like Sezzle, I for the life of me, I don't know. I mean, I knew the float was low, but still there's a lot of small funds out there. Like I don't know. And so just building that story and then getting conviction on that story as you watch it progress and having that long-term mindset of like let me hold this thing like 2 years, 2.5, 3 years, like and see like is this story playing out how I want it to play out and or how I expected it to play out. And how am I pricing my risk and stuff like that? Because at the end of the day, investing is a risk reward game. It's an economic value on the risk to reward, and building that story and just practicing and being wrong and identifying why you're wrong. Like, did I actually make a mistake, or was the risk I identified the real risk? And like, would I make that choice again, type of thing, and learning to size how confident you are and stuff like. I mean, all of that's just getting into it. I mean, that is the number one thing is just play around, get into it. Don't be afraid to lose money, but make sure you do the work and and hopefully you end up making money and stuff. And that's definitely like the mindset I would go in. And
Yeah, for sure. No, I mean it's a big it's it's interesting. It's the big difference between just like creating a thesis and then building,
Mhm.
writing the essay, your story
Right,
around your thesis, which I
right.
think that's
And
incredible advice.
writing is like write your thesis down. Right. And
Yeah.
like I would say like that was a huge changing point is when I started writing stuff online like 3, 4 years, whatever it was, 4 years or 3, 4 years. I mean, the caliber of how I understood my investments went up even further. Just writing it down and like building that story for yourself really helps you like, oh crap, I didn't realize that management's compensation is horrible. Nobody owns any of this company. Like, how have they acted in the past? Or like for for a recent investment I just made, the CEO died. Like, how does that play in? And you would miss those things if you weren't like really just digging in and building the story and like, well, or that not the CEO died, the biggest owner died, and the CEO is resigning. Um, and like just building that story is just so pertinent to investing and where it's going to go and how they've done in the past and stuff like that.
Absolutely. I'd love it if somebody who's listening out there like created a series of chapter books on just like various theses and just like how they played out, like from beginning to, whether they became large cap or they got acquired or something like that. That would be super, super interesting. I mean, you get that, some of them, don't get me wrong,
Yeah,
but like a full on, like, like they
right.
turn it into like a full narrative. Like not, I'm really into like nonfiction narrative books right now. So like,
Yeah.
that'd be
Yeah, that's
maybe.
kind of where I'm on the like the nonfiction narrative stuff right now too.
Yeah,
That's kind of fun.
they're just really fun books. But anyways,
And then
and also it's cool
my
because it's
fiance
like
looks at them and
grounded.
is like, "Ooh."
Yeah. Reading The Tiger by John Valant right now. So
Okay.
yeah, that one was fun. I just finished Born to Run. That was like the last two have been nonfiction narrative, and like all the rest that I have on my list are like, yeah, it's the same stuff. Anyways, we'll
Yeah.
say that for another pod. So Jacob, with that, where can our audience go and find more information about Rogue Funds? I'm not sure if you're on social. I mean, we met in person, like the old-fashioned way. So, I'm not even sure if you have an X or anything like that. It's
Yeah,
X.
so I have an X. It's JARO underscore rogue. And then the website is rogue dash funds. It's ROGUE dash FUNDS.com. And the blog there would take you to the Substack. It's integrated in with the website. And then I post my most recent quarterly letter, most recent tear sheet, and most recent marketing deck on the website as well. So all of that information is on the website. And yeah, those are just, you can email me if you really want to talk about anything. I mean, if you have an interesting stock, I would love to hear about it. I'm not afraid of anything. And
Cool.
yeah.
Very cool. Well, Jacob, thank you so much for joining me today. This was really fun, and good luck. Stay safe. I look forward to our next update. All right, man.
All right. See you, buddy.
See ya.